Let's begin Chapter 16. A company cannot achieve or maintain profits without carefully managing cash. Managers and other users of the financial statements will always pay attention to the company's cash flow position. So in this chapter, we're going to explain how we prepare, analyze, and interpret the statement of cash flows. We will also discuss the importance of cash flow information for predicting future performance and making managerial decisions. The statement of cash flows helps users determine how a company obtains its cash and where it spends the cash. By providing this information, this statement helps the users to explain the change in the cash balance from the beginning of the period to the end of the period. While it is important for the users to know how much cash a company has, it is also very important to know how a company funded its operations. Did the company have to borrow money or sell shares to help pay the operating expenses of the company? If yes, then we need to be aware of this, so that we can fully assess the cash flow position of the company. Cash flow information is also very useful to determine if the business has sufficient cash to pay its debts, or if the business has paid any dividends during the period. When we talk about cash, it includes currency, that is the notes and coins, and cash equivalents. Cash equivalents are very short-term, highly liquid investments that are easily converted into cash, and they have very little risk of loss. An example of a cash equivalent is a very short-term treasury bill issued by the US government, and it is very close to the maturity so that it has very little risk in getting a loss when we sell it. There are three basic sections in the statement of cash flows: the operating activities section, the investing activities section, and the financing activities section. The operating activities sections include cash inflows and cash outflows that result from the normal operations of a business. Operating cash inflows mainly include cash received from the customers in payment of the goods sold. Operating cash outflows include cash payments for salaries, supplies, inventory, and taxes, etc. The investing activities sections includes cash inflows and cash outflows that result from the sale and purchase of fixed assets and investments. For example, if a company purchases a piece of equipment, it will be classified as a cash outflow in the investing section. If a company has excess cash and invests in the shares of other companies, it will be classified as a cash outflow in the investing section as well. If in the future this equity investment is sold, it will be classified as a cash inflow in the investing section. The financing activities section includes cash inflows and cash outflows that result from the transactions with the creditors and shareholders of the company. For example, if a company borrows money from a bank, it will be classified as a cash inflow in the financing section. If in the future this debt is repaid, the amount of the principal payment would be classified as a cash outflow in the financing section. If a company issues its own shares, it will be classified as a cash inflow in the financing section as well. Among all cash flows, you may need to pay special attention on two items: interest and dividends. IFRS allow alternative classifications of interest and dividends received, as well as interest and dividends paid. Interest and dividends received may be classified as operating cash flows because they enter into the determination of profit or loss. Alternatively, interest and dividends received may be classified as investing cash flows because obviously they are returns on investments. Interest paid may be operating or financing because it enters into the determination of profit or loss, and at the same time, it is also a cost of obtaining financial resource. Dividends paid may be classified as a financing cash flows because they are a cost of obtaining financial resource. And alternatively, dividends paid may be classified as a cash flows in operating activities in order to assist the users of the financial statements to determine the ability of the entity to pay dividends out of the operating cash flows. Some transactions involve investing and financing activities, but no cash. An example would be the purchase of equipment, and we pay for it by issuing our own company's shares. So in this transaction, the purchase of the equipment is a kind of investing activity, and the issuance of our own company's shares would be a kind of financing activity. But obviously, there is no cash involved in this transaction, and the transaction should not appear in the statement of cash flows. However, because of their significance and the compliance of the full disclosure principle, these non-cash investing and financing transactions must be disclosed in the financial statements or in the notes. So the slide here shows two more non-cash investing and financing transactions that require separate disclosure. The first is the retirement of debt by issuing equity securities, and the second is the conversion of preference shares to ordinary shares. So for these transactions, there's no cash involved, but they are so significant that we need to disclose them to the users of the financial statements. So here comes to the end of session 1. Now you can try the concept quiz to test your understanding in this session.